All right, so we're talking today about the looming tsunami of foreclosures that some people are expecting to be coming. I don't think that's going to happen. Let's talk about it and figure out why it's completely overblown. First off, if you would look back, going back through June until February, the folks who have exited forbearance, over half of them have actually exited forbearance, paid in full. They've been in forbearance and then they rectified it, paid in full, and exited. A third of the folks are on a repayment plan to get healthy, and only 1/6 of the folks are still in trouble. So that's pretty good news. Now, if we look at the total percentage of loans in forbearance, going back to May of last year, 8.5% of the loans that in existence in the United States were in some form of forbearance. That's now down to just 5%. To me, that still sounds like a lot, 1 in 20. But we are definitely on an improving trend, and not all of those are going to exit in foreclosure. They're not all going to be in bad shape. Many of them are healthy and just taking advantage of a great program to improve their position financially, whether it's business or personal. So there's going to be 325,000 people that are going to exit forbearance over the next 6 to 9 months, and they're not going to have a plan in place. And some, and probably not all of those folks, are going to be in default. But let's go worst case. Let's pretend for a second, this is crazy land, that all 325,000 of those loans are all in foreclosure and they all dump on the market next Wednesday. That's worst case. What would happen? Well, in reality, we'd have a normal supply of houses. So if you take a look at this chart right here, this goes back and shows the January inventory going all the way back to 2016. You see that in January of 21, the current supply actual inventory was 325,404 houses across the nation. And all those folks that are in potential foreclosure, if we dumped them on the housing market, be another 325,000. So we would actually end up with a normal supply, actually a little bit lower than even last year, of houses on the market. That's not an impending tsunami of foreclosures, right? Well, what does it mean? It means that housing prices are not necessarily going to be dropping. Matter of fact, they're probably going to continue up, just as they did last year. So let's talk about home price appreciation. Last year in 2020, the average the increase in value is about 10% home price appreciation. And that means for the average homeowner, they've accumulated approximately $24,000 in housing wealth. If you've got something above the median home price, it's probably more. If you own rental properties, you've got even more beyond that. So that's great if you're a homeowner or a landlord. If you've been sitting on the sideline waiting for the impending drop in the market to get in, you may be disappointed in the fact that there's been so much growth and that drop is probably not happening. The forecast going forward into 2021, we're looking at about another 6%. Last year was 10%, next year 6%. How does that compare looking back? Well, if we go back to 2008, when we had a bubble, we were seeing a year-over-year annual appreciation for those 4 years right there of about 10%. Going back 4 years from where we are right now, we were seeing an average of 6%. Now, granted, last year was about 10, but on average it's 6%. That is a high but sustainable growth rate. So early 2000s, completely unsustainable, 10% a year. Right now, we're looking at 6% a year, more sustainable. So that tells us that we are not approaching that same dramatic bubble and drop like we saw in 2008. Back in 2008, afterwards, we saw a high percentage of distressed properties on the market. 1 in 3 sales in January of 2012 was a distressed property, meaning a foreclosure or bank owned. And now we're down to less than 1%. And that imagine if we took those 300,000 homes and dumped them on, we would still not be in that same 1 out of 3. It would still just be a few. It'd be some. It wouldn't be nearly as bad as that late 2000s, 2010 timeframe. One of the other things that can affect home values, especially going forward, is interest rates. So as we look at interest rates going forward, we know that last year and before that we were looking at 50-year lows in mortgage rates. They were down below 3%, down to 2.7. And since then, last fall, they've actually gone up 30 basis points, meaning 0.3%. We're right at about 3% now. Mortgage rates here, this is a chart of Freddie Mac 30-year fixed rate. We can see right now we're at 3%. Last January, we were down, this January, we were down about 2.7 and going steadily, up, going backwards, however you want to say that. Looking all the way back to 1 year ago, we were at 3.7. So we dropped a whole point over the year, and we've ticked up about a third of the point. Well, what about going forward? Well, mortgage rate predictions over the next year. So we've got 2022 first quarter down at the bottom there. You can see across the bottom, the average across all four of those, Freddie Mac, Fannie Mae, Mortgage Bankers Association, National Association of Realtors, we're looking at an average of about 3.2%. That's still stinking low, so that's really good for the homeowners. Whoops. And looking at the graph here, you can see the mountain chart on the left. That's historical. The red on the right. This is Freddie Mac's prediction that we're only looking at 3.1. So wow, we're only seeing a growth of approximately steady interest rates, a little bit of an increase over the next year. And why we are so concerned with interest rates is that as interest rates go up, housing prices can go down. But right now, what we're seeing going forward is that it's not going to be there's not going to be a dramatic increase in interest rates, which means there will not be a significant or any down pressure on prices from interest rates. And that's great news if you're a homeowner. The other thing that's different about 2008 is mortgage credit availability, meaning the quality of the buyers and how easy it is for them to get a loan. Looking back over the last 12 months, the time to close a loan has gone from 45 days up to 60 days. The banks are, granted, part of it is that they are just overwhelmed with volume, but also there's a lot of due diligence. There's very few of those no document loans, if any, and all that stuff that we saw in 2008, we're just not seeing now. FICO requirements, the FICO score average right now is 750 for the average homeowner. So if we look at the distribution on that, just take a look, 750 to 800 is over a third of new home loans that are being used to purchase homes right now. That is a very high FICO score, which tells us that the borrowers are financially healthy and have good spending habits, good debt to income ratio, which tells us that they are quality home buyers for the long haul. The average FICO for all loans is about 752. Conventional, a little bit higher, 757. FHA's bringing it down. VA's bringing it down just a touch. Average debt to income ratio. Debt to income is like golf. Lower is a better number. So, and we would like to have about a 30 to 35% debt to income ratio. That would be great. And you can see that if we average all loans, that's where we are. FHA is a little bit higher. VA is just a touch higher. Numbers that we would expect, but those are healthy debt to income ratios when it comes to borrowing money. If you have any questions, I'd love you to reach out. Give me a call. We can talk about this more. We can talk about interest rates all day long and how this will affect you. But in the end, if you're looking to buy or sell and you need some help, you need a wingman, give me a call. Talk soon.